Hello, everyone, and welcome to another episode of Buyouts, Business, and Bourbon. We got a great conversation today with both Josh Freeman and Richard Reyle. Richard, my long-term partner from Questar Capital Partners. Josh with Sanctuary Wealth. We're here to talk about exit planning for middle market companies, a little M&A discussion. Talk a little bit about how companies can do their transactions tax-free. And we're going to have a lively conversation with both these guys. But before we get started, let's talk a little bit about each of your journeys to where we are today. Richard and I have a little bit of the same journey, but I want to hear from the horse's mouth, and so our listeners can hear a little bit more. So why don't each of you guys talk about how you kind of got to where you are today?
All right. Well, first and foremost, thank you for having me. My name is Josh Freeman, and I'm the head of capital markets at Sanctuary Wealth. We're a $60 billion RIA and broker dealer. But my path here really is a long one. I've been in the independent investment space my entire career. This is 29 years. I'm in San Antonio, Texas. I bounced between San Antonio and Austin, Texas over the course of my career, but always on the independent side, striving to create a capital markets experience that can rival a lot of the bigger investment banks, even though we're on the independent side. So this is my third stint of running a capital markets desk for an independent firm. And so very excited to be here and talk more about how we in the independent world can compete in this space, in this ESOP space, in this business owner private space.
And I'm Richard Reyle. I've been a lifetime partner with Jerry, going all the way back to our early days at Merrill Lynch. We got into the business together uh, 30 plus years ago. Uh, as I always jokingly say, more years than I want to count. And we've slowly evolved from the wirehouse world to 2 decades at Merrill, another decade at UBS, and then we founded Questar Capital Partners, in almost 4 years ago, and it's been a roaring success. My capabilities are mostly around portfolio management. All the way back in the early days at Merrill, I was one of the very first portfolio managers appointed, I think in 1999. That was a very new and rare thing for FAs in that world to be able to manage portfolios for clients. And as we've evolved into the ESOP space, this is kind of an area that really I'm excited about because it's a way that we assemble portfolios that are a big part of the process that allow these tax-free transactions to happen, which of course is a huge selling point. And for anybody thinking about doing an ESOP of, hey, I get to monetize a business, not pay a whole lot of money back to the feds in the process. So putting together portfolios that make that arrangement possible is an exciting part of this and something we're going to explore today.
Great. Well, thank you guys. Um, as we know, business owners, middle market business owners, baby boomers are aging, and many of them need to figure out an exit plan. And I think that between the ages of 55 and 70, they said something like almost 70% of businesses have owners in that range. And they're all thinking about it, right? Because the business owner is always thinking about when and how am I going to sell? What's the most tax efficient way? What does my estate planning look like? What do my family members look like as part of the estate planning? Are the family in the business? Am I charitably inclined? Do I want to parse off some of the business to charity prior to a sale? How am I managing my assets and cash flows? What is my real estate situation? So the mind of the business owner, it's complicated, right? We're trying to solve a pretty complicated problem here. And I think that there's only several ways that owners can really sell their businesses. Number one, they could sell to a strategic in their business, right? They could sell to private equity. There's an awful lot of private equity money out there today. They can sell to an ESOP, which is basically selling to your employees. Or they can, if they're financially secure themselves, they can give shares to their family and keep the ownership within the family members if there's capable people in the family to run this company for the next generation. So there's four real ways. Today we're focusing on the ESOP, the employees basically owning the company post-transaction. And that is because the major tax benefits exist for that option. And there's only about 300 ESOPs done per year. And you may say that out of all the companies, privately held companies out there that are sold every year, 300 seems like a small number. And I think that my theory on that is that if I own a cement company, and I'm not a financial guy, I'm a cement guy, and I built up this great company over a period of years, and I'm going to sell, who do I turn to? I turn to my lawyer, my corporate lawyer, my accountant, and say, hey, look, is there a middle market banker you can introduce me to talk about an exit or a sale? And my theory is that 95% of middle market investment bankers just do strategics and private equity. And it's a very kind of niche investment banker that works on ESOP transactions. So more than likely, that cement company never even hears about an ESOP being one of their options, because most of the bankers are just in the strategic and private equity space. So I think that's the main reason there's only about 300 new ESOPs done per year, and there's a little over 7,000 that exist today. So what are the main benefits of the ESOP? Obviously, we talked a little bit already about the tax benefits. We're going to get into details on the tax benefits, both for the employees and the owners, the selling shareholders. Also, the shareholders can keep control of the company with the ESOP transaction. Okay, so that's important. Legacy is important for many people. So if they want the legacy, they want it. The employees will continue to get allocations of shares into their hands every year after evaluation's done. So the employees really truly become the owners of the company. And there's also the last benefit really is involving incentives. So if you want to take care of your employees and you want to take care of your management team, there's ways that you can build in incentives. So if I'm the CFO of a company that's going ESOP, I don't own any shares. I'm not going to participate on the sale itself, but the owner wants to take care of me as the CFO and a long-term employee. They can build in what they call stock appreciation rights. And there's ways that you can do that. So the ESOP transaction for the right company is literally a grand slam home run. So today, we're not going to focus in on most of those benefits. We're going to focus in on really the tax benefits to the owner and the employees themselves. We'll talk a little bit about that as well. So to talk about the tax benefits, it's under Section 1042 of the IRS tax code, and that basically is very similar to the 1031. And the 1031 is where you're exchanging real estate, commercial real estate, especially with large embedded gains, and can exchange it to another property. Why, as many times you talk to these owners and they can't understand why they can sell this company tax free. Why does that exist? Why does the IRS allow it? But under this 1042, it's very similar to the 1031. They're exchanging privately held company stock into qualified replacement property. And I don't know, Josh, do you want to take a shot at explaining qualified replacement property in a little bit about what that means? Because basically there's several different types of qualified replacement property. Are the most common. Real estate, which we don't really deal with, but real estate is an option for people. And you could talk a little bit about the floating rate notes option, Josh, if you want.
Yeah, I would say that's sort of my area of expertise, so to speak, would be that section of qualified replacement property that factors into being a long-term floating rate note. So when you take that part of the code and you take that note as being qualified replacement property, that's where we really come in from our side to leverage our relationships with banks and companies that issue long-term floating rate notes that are classified as qualified replacement property as part of that 1042 code. So it allows the business owner to take a like asset for a like asset, to take the proceeds from the sale of that company and reinvest those proceeds into qualified replacement property. In this case, what would be a floating rate note. And that's where that tax benefit comes into play. That exchange allows them not to pay taxes on those gains. And we're certainly going to dig in, I think, a little more to that, but from a high level, that's how that works. And I'll kind of turn it back over to Richard and Jerry if they want to elaborate.
Yeah, I mean, I'll jump in a couple points, I think that are important to make. I mean, just one general comment, I always like to, you know, the one universal thing, we talk to investors all the time about features of this and that, but the one thing that ties everyone together are taxes. So the second you say, hey, you don't have to pay taxes on this, because no one ever said, hey, I wished I paid more taxes on something, right? So it's the one universal thing that people go, oh, wait, I can sell my company and not pay taxes. And the other important thing I think to always bring up about this is it's not some complicated in the sense of, a lot of these things where you see trying to get out of paying taxes, it's some, wrangling between the tax code. This is written in the tax law. So this isn't some complicated scheme that some creative lawyer came up with. This is just obeying the tax code is written. You follow the rules of doing an ESOP. It's tax free by its definition, as long as you follow the rules that are already stipulated. So you're not going to get challenged in tax court or anything like that. So you do this right. And that comes back to assembling the team that knows what they're doing and having the expertise, then it's going to sail through any kind of tax challenge or whatever. So you're not running the risk of getting audited and the whole thing coming apart. But yeah, a feature of that is then, yes, you have to take the proceeds and put and buy qualified replacement property. And as Jerry mentioned, there's a couple different things you can do. Our preferred method is to utilize, floating rate notes. And why? Well, the number one reason, and this is a big part of the deal, is because because of the way they're structured, floating rate notes, they float. So there's no interest rate risk, which is one of the problems if you're buying any kind of fixed income securities. And because they are issued by investment grade companies, we're going to be borrowing some money based upon those securities, and we're going to get the highest levels of borrowing capacity. So the amount of collateral you have to place is very small in relation to the loan, basically about 10 or 15% of the overall transaction value. So you're getting maximum amount of borrowability from these securities. You're limiting your risk completely to any kind of interest rate risk. And obviously, since we're using investment grade risk, we're taking a lot of the overall credit risk out of the situation. So it's about your least risky way to go about investing in this. Any other investment property that you're investing in, whether it's real estate or stocks or anything else, have risk embedded in it. So again, this is the least risky, most conservative way that we've found in order to do this. And then after that, it's a portfolio construction exercise between people like myself and Josh that are we have Jerry did mention this part about, you have about a year post close of your transaction to assemble this portfolio. And that's when we close a brand new ESOP, we take a year's time to, and that's nice. You've got a good bit of time to assemble a quality portfolio that's diversified to issuer and industry. And there you go. Basically what we do to kind of assemble that.
Great.
We get into more than and the nuts and bolts of that, but that's the bigger picture view of it.
So a lot of business owners basically are saying it sounds too good to be true, right? So the execution of this real life is if one owner sells a business for $50 million, for instance, what they have to understand is that you have to take that entire $50 million and show the exchange for the 1042. So as Richard mentions, we have 12 months post close to buy $50 million of a diversified portfolio. And then we find a lending bank institution that basically assists us in the transaction that will loan about 90% against that. So what the owner gets is basically the owner has to keep about 10% equity. So in this case, in that example, they keep $5 million of equity at a lender like a Citigroup or like a Deutsche Bank, somewhere there. And then the remaining amounts that are paid to them between cash at close and seller notes payments are all tax free as long as you keep that portfolio intact. One thing that's important in this portfolio that Richard's going to get into building is that you cannot sell securities. Once you purchase QRP, they are held, which is why the floating rate notes tend to be long-term in nature for a reason, so that you don't have to sell them. They don't get sold. And because once they get sold, you're generating capital gains on that piece of the sale. So if you have a $50 million portfolio of 10 different bonds, 5 million each, and you sell one, that 5 million will generate capital gains that year of the sale. So what you're trying to avoid by doing this method of 1042 is if I'm 70 years old and I'm selling my company, I buy myself a 50-year floating rate note. What's going to happen is at my death, whenever that is, there'll be a step up in basis for the family or my heirs. So what happens is basically you've essentially sold your company in 2026, bought these QRP, bought these long-term loans, notes, and then you basically get a step up in basis at my death so that the heirs never pay tax on the sale of the company, which is really the benefit of the floating rate notes. And Richard, I'll let you get into a little bit of equities. Now, equities are allowed to be QRP, and many times owners will say to us, "I'd rather buy stocks than boring floating rate note bonds," but the stocks have an issue of the margin capability and the volatility, and I'll let you address that.
Right. Yeah, I mean, there's no doubt. And, this also goes back to the age of that seller. If somebody's 75 and selling, they probably aren't interested that much in an equity portfolio. But I understand if somebody's, a couple decades younger, they're like, this money's going to be sitting here for quite some time. What can we do about that? And one of those things is, yes, we could take the same dollars and buy equities, or at least a portion of that. But the but to that, and the caveat to that is twofold. One, you're not going to get the same borrow capacity on those securities. Basically drops from maybe 90% capacity to 50% traditionally has been that. And so you're going to have to post more collateral. So that's going to be the trade-off that goes on in doing so. However, again, if you got somebody with 3 or 4 decades of lifetime in front of them, at least for a portion of that money, it can make sense. And again, the same caveats apply as Jerry mentioned. We would buy, a quality portfolio of, 100 dividend paying stocks, and we have to hold those. And that's the whole point. So, but there will be, traditionally, in any given year, 5 of those companies will get acquired. Something will happen that will cause there to be, without you actually selling it, there might be a gain associated with that, especially if it's a cash deal. If it's not a cash deal, that may not be the case, but you will have to that's a little bit of the hair that's on that transaction a little bit, but it's possible to be done. And we've seen it done and we can do it. That's the capability is there. But the same thing applies even on the floating rate notes. Again, we can buy different maturities, especially in the secondary. And that kind of gets into maybe one of the advantages that we have as an independent where, Jared, you might want to say this to lead us off in this is just who are the traditional players that you're going to run across in the ESOP space, especially if you're running across into the Merrills and that sort of thing. Maybe talk about that for a second, and then I'll lead off with some of the differences.
Yeah, the traditional brokerage firms. Now, Richard and I came from the UBS world. At UBS, we were involved with ESOP transactions. UBS, Morgan Stanley, JP Morgan, and RBC are the primary players in that market. And they're primarily using, new issues to fund the QRP. As Richard mentioned, in the independent space, we have a lot more flexibility. We're considered open architecture. We don't have just one solution. We have many solutions, which do include real estate, equities, fixed income, right? Everything that's available, and buying bonds, floating rate notes on the secondary market, which is considerably cheaper for the client. So the business owner is in the middle. You really can empathize with the middle of a transaction. This is the biggest transaction of that owner's life. And they have a million people calling them, lawyers, accountants, investment bankers, trying to get a transaction done. So us trying to talk to the client about the 1042 strategy is one of 100 to-dos that owner has in the middle of the transaction. And then the second this transaction ends, then we get involved. But getting back to the major players, those major players also have one place where they typically place the margin loan. Now, the way to think about this transaction is going back to that $50 million example, is that now you're buying $50 million. We're doing this for you. Put in the other portfolio, $50 million of QRP, floating rate notes, and we're taking out a $45 million loan. Okay. Now, if you're getting a mortgage, you're going to shop the mortgage rates, right? You get a $45 million loan. Wouldn't you think you want to shop that? That's the advantage we have in the independent space, is that we can go out and shop those loans with several different banks, and even saving 25 basis points on a $45 million loan is going to save a ton of money. So I think that what we bring to the table is the true open architecture in this space.
Yeah, if
Well,
I
I
can
mean,
add to
I'll
that.
put a more finer point on it, you know, in the sense of, we came from UBS. So if you're doing an ESOP with UBS, guess what? The loans coming from who? UBS. Replacement properties coming from, guess where UBS is, if they're not involved in the underwriting, they have no interest in putting that floating rate note into your portfolio. So it's all their home cooking, and that's all you're getting. And with us, completely opposite. On the loan side, we'll shop it to everybody. And the same thing, floating rate notes, we'll do new issues. We'll go find secondaries. And, we get into, and I'll step into this part, we can also use a structured note desk of all the major investment banks to create, essentially, I'll call them synthetic floating rate notes, but they loan this, our banks will loan exactly essentially the same thing. So even though we're kind of considering them synthetic floating rate notes, they walk like a duck, they talk like a duck, they're a duck. So they are a floating rate note. So we're able to utilize those, which there we customize them however we want to. We can make them as long as we want. We shop them according to rates at whatever the prevailing rates are at that moment in time, and compete against all the desks to get the best rates at that point in time. And we get to pick the size. So it's really the best of all worlds. So we have completely different world that we're able to pick these investments from and be completely objective about it, because we don't care. I mean, I don't care where they come from. We're getting them from wherever and can just assemble the correct portfolio. And I think we get a more broadly diversified portfolio, which is the end game that any investor wants.
And Josh, we have there's no disadvantage in the independent space on being able to get new issues from the big brokerage firms, correct?
Yeah, that's correct. I wanted to elaborate on several of the things you guys have talked about, not to belabor the point, but really just to kind of drive those things home. When you talk about the competitive advantage that we all have on the independent side of having a capital markets desk and having all of these syndicate agreements on the new issue side with every major bank, domestically, globally, there's those three phases that you've already talked to, right? We can go to any one of those banks and issuers and have them create a customized QRP floating rate note specifically for your client, all investment grade in the names of financials. We can go to those people and say, we need a non-financial. Can you have them issue that for us in that new issue market? So it's not just leveling the playing field as an independent, it's actually almost tilting it in our direction, because from the new issue side, we have access to certainly the same, and in most cases more issuers, more names, more flexibility. And that's a big differentiator on the new issue side. Certainly on the secondary side, right? We have access globally, domestically and globally to uh, notes that are coming available in the secondary market. That really, really sets us apart from that standpoint. And then lastly, and you've already touched on it, that's the lending, right? We're going to shop lending. All of the biggest domestic and global banks that are players in this space, if we want to take them, Jerry, to your $50 million example, the client's going to deposit 5 million and he's going to buy 50 million in floating rate notes. The $45 million loan has got to come from somewhere. So we're going to shop that out to the biggest and best banks domestically and globally to make sure the client is getting the most competitive loan structure on that. And then to kind of back up to something else on the equity side of things, I think, and you guys really can speak to this, and in that example, the client's depositing 5 million, he's buying $50 million worth of floating rate notes, qualified replacement property. He then has that 45 million to diversify. If he's age appropriate, he can take those proceeds and he could buy equity and he can buy real estate. It allows him the flexibility to sort of expand his portfolio, knowing that he's got the safety and security of this QRP that's going to be stable, not fluctuate, not have any interest rate risk. So it's really all four of those things from an independent standpoint that really, really sets us apart.
Yeah, Josh, you brought up a great point, which is that's the thing I didn't even talk about. Yes, the cash that he's actually pulling out of the deal is available for investment. So that's the whole point. So if he chooses not to do equities inside of the 1042 structure, yes, he's pulling cash out of the business from the deal most likely. And there is where you can add equity, a traditional equity portfolio. So looking at it from a bigger picture point of view, the 1042 account is just a piece of the overall investments that are going on. And again, you've got the safety and security of floating rate notes inside that 1042 account that, okay, that's not going anywhere. We're secure. I can take risk outside of that portfolio that are appropriate for my particular situation.
Do one of you guys want to talk a little bit about the credit risk on those floating rate notes,
Yeah, I mean, I think
the
look, you can
ratings and all that?
yeah, you can chime in too, but I mean, obviously, we're talking about the biggest and best financial institutions in the world. Insert Goldman Sachs, J.P. Morgan, Citigroup, Morgan Stanley. Names like that, Deutsche Bank, RBC, places like that. But also, we're using those big banking institutions as our structuring desk to go find investment grade non-financial companies. Well, think about companies like a Procter and Gamble, just as an example, right? So you are wanting to consider the investment grade rating of the company that's issuing the QRP, the floating rate note, but they're all going to be A rated or better financial institutions or domestic companies that sort of fit that bill. And then the diversification is a big part of that. It is not putting everything in one of those names. It's spreading that out over 5 to 7 to 10 different investment grade names, just to continue mitigating that risk as well.
Yeah, and just look over the last year, Josh, the names that we've done from UPS, Procter and Gamble, Exxon, Chevron, Southern Company. These are utilities, oil companies, consumer products companies. These, as I always jokingly say, these are the types of companies that will outlive all of us. So from a risk standpoint, yeah, these are not the latest tech names. We would have no interest in that. We'll take those risks elsewhere in people's portfolios. So these are very, not just long dated securities, but companies that have literally almost a century of history behind them and probably in front of them also.
So the owner basically looks at all these benefits of the ESOP, right? They look at the tax benefits, the legacy. I keep control of my company, and they're like, okay, this is too good to be true, right? What are the costs to execute something like this? So obviously there's a cost to the margin loan, and there's a floating rate note interest. And a client that is selling the business for $50 million could save potentially 30% of that or so between capital gains in their state plus the federal, right? So you're looking at probably a 30, potentially 30. And if you're living in a high tax state like New Jersey, New York, or California, potentially higher. So you're looking at a third to 35%. So if I'm saving $15 million, they're like, well, why doesn't everybody do this? Okay, well, first of all, it's complicated, right? You got to build the portfolio. So it's not quite as easy just selling your company and getting a wire and paying your capital gains tax. You have to set up this portfolio that basically sits. The way I like to explain it is everybody has their own personal balance sheets of their investments, their real estate, and anything else they own. This is kind of often its own separate island, is a big fat $50 million QRP portfolio plus a $45 million loan with $5 million sitting there in equity. And you think of it as on its own island, this 1042 execution. Now, I don't know if one of you guys want to address a little bit of the negative cost of carry, the interest rate that you're achieving on the floating rate notes that you're earning on those floating rate notes by holding that $50 million portfolio is not going to be as high as the margin loan, which is going to be at a higher rate. So the client will be responsible for the difference in rates. I don't know if one of you two want to discuss that.
Yeah, pretty simple. It's just you've got a loan outstanding that you're paying interest on, and I'll just pick it out. Let's say it's $250,000 of interest you're paying that year on that loan, and your floating rate securities that you do own are going to be paying income to you coming in the door. And based upon where rates are at any given moment, and this will fluctuate over time because, as we know, rates do move around. Um, your cost to carry, the differential between those two numbers, it may be negative, and often is negative. but it's offset, and that's the whole point. And you're saying, and so here's the real in the no absolute free lunch here. I'm saving 15 million, pick a number in illustration. You said, Jerry, 30% of that 15 million, $20 million in taxes. And yeah, I got to pay maybe $100,000 in interest carrying costs per annum to make this whole deal fly. And that's the real issue that you have, I think, with these deals. And it's a little bit variable because again, rates move around, and it can go positive if rates fall enough. We've seen, back in 2022 prior when rates were zero, and and Josh, you probably agree too that rates probably ain't going back there anytime soon, but you never know. Uh, the likelihood is that's going to be a negative carry for these deals going forward.
Yeah, I think that also just to, that kind of brings back in that competitive landscape, right? So on the loan side of things, we're going to go and put banks in competition to make sure your client gets the most competitive lending rate that we can find for them. And then as we're structuring the floating rate notes, making sure again, we're shopping these and building this portfolio to make sure that you're getting the most competitive floating rate notes. So you guys described it perfectly, right? There's a cost on the loan. There's interest being received from the notes. Whatever that offset is, sometimes it's in the client's favor, sometimes it's not. But certainly the tax savings very, very much outweigh that's a major benefit, from that standpoint. And then also just to make sure everyone understands too, in this example, Jerry, you're putting a $5 million deposit, you're buying $50 million worth of loans. The margin loans on 45, but you're getting the full interest on the 50 million. The 50 million of loans of notes that you own, you're collecting interest on all of those, not just a portion of those.
Yeah. And then looking at the whole transaction for the owner, many times we're looking at this, and if it's a $50 million transaction, more than likely they're receiving about $10 million cash at close, and they have seller notes from the company that are basically, receivables that they're earning interest rate on too. So they're going to earn the interest on those seller notes, and then that helps as an offset for the negative cost of carry. So at the end of the day, when we put all these numbers together in a feasibility study, the owners can see the real benefit after the costs, and they could see major benefits of obviously utilizing this money and reinvesting that money.
And I think, as you guys mentioned earlier, not many people are telling business owners about this, even giving this option. And so, being able to sit down with a business owner, have this conversation, and really thoughtfully lay out how a transaction like this works in comparison to their other choices, it's incredibly valuable. And again, it's just another differentiator in the independent space.
And I think that the business owners listening to this and their financial advisors as well, I think the key is nobody really knows, is the ESOP right for me? And I think that when you find an investment banker that can do a 2-track or a 3-track, I think that's important, because if you're really unsure whether this is going to work for you, what you do is you just basically we can help you bring in an investment banker that can look at, okay, what is a private equity sale going to look like on an after-tax basis compared to the ESOP, right? Because the ESOP valuation may not be exactly the same as the private equity valuation, but the ESOP valuation, if it's a C corp, as we mentioned, it's got to be a C corp to elect 1042. And if they switch from an S to a C to elect the 1042, what does their after-tax proceeds look like? And I think the business owner many times wants to see both options, if control and legacy and things like that are not as important. So, any closing comments from each of you guys before we get into the bourbon side of this?
Nah.
I think the
Well,
only
I
thing
would
I'll
say
add
too,
is just how much the landscape has changed. This used to be a transaction that was controlled almost exclusively by a handful of very large investment banks. And now, we have shown and demonstrated the ability that we can not only compete in that space, but win in that space. And so that opportunity is super attractive and just very exciting to us all.
yeah, and I think one thing you kind of didn't mention, and that I think always needs to be mentioned about an ESOP, because a lot of these businesses, as you mentioned, Jerry, are, these longstanding businesses that have deep roots in their community. And I think, if they actually do an ESOP and they sell to their employees, I mean, it's a feel good thing. And I think they're going to get great press. They're going to get, you know, um, a lot of kudos in their community amongst their employees. Because one thing we really didn't touch on is like the shares themselves are actually given to the employees. The employees aren't writing a check for those shares. So they may have some time where they have to vest before they obtain them and have full ownership, but they are, it's truly, if it's, we joked about one of ESOPs that was very successful. They had them on the news locally, and you would have thought they literally gave the company away by the way they were portrayed in the media. Like they didn't even mention that they walked away with a very fat check, paid for the company, but they just sounded like they were Mother Teresa that gave them away. And it's like, wow, these are the most wonderful guys on the planet. The PR benefit, I don't know, that's going to be the driving force, but again, most of these companies are longstanding members of the community. And I think it's just an important thing is they're going to get a lot of, attaboys and pats on the back by doing these transactions if they follow through on it.
Yeah, one of the transactions, one of our recent transactions, I asked the owners, how they found out about doing an ESOP. And he basically said, I was at a public supermarket, which is very well known as the largest ESOP in the country. And they're at the deli counter getting roast beef. And he literally is making small talk with the guy at the deli counter. And he saw a sign said we are 100% employee owned, and he just made small talk and say, what does that mean? And he goes, what it means is I have over $1 million in my ESOP account. So you think about this, like, rank and file, all employees get share allocations every year. And I believe Public's been an ESOP since the 70s. So if you've been there for a long period of time, you're getting shares granted to you every year into your ESOP account. And if the valuation keeps rising on those shares every year, you could see where you can instantly, like your 401k, many times this is record kept with your 401k. You have a 401k on one side and the ESOP account on the other side. Both are ERISA plans, and your ESOP account can be dramatically increasing every year based upon new share allocations and the valuation increase. And they always say that, ESOP employees are the most satisfied employees. And there's a lot of studies done on that. There's just not
Yeah,
enough of
well,
them. 7,000 is not enough. We need to get some more.
I can living in Florida. I can speak to I don't care where I buy gas. I don't care where I go to the a lot of places, but I only go to Publix to buy groceries because it's a cut above everybody else around here. So it's well-run company.
It's a great story.
So on a lighter note, there's a bourbon in this title of this podcast. So bourbon doesn't have to be your drink of choice, but I want to hear from each of you guys on your favorite bourbon or your favorite drink of choice. Because after you do an ESOP, you definitely need a cocktail.
Yeah. But Buffalo Trace is my daily drinking bourbon.
Okay, thanks. I've recently stumbled into. I've been, I make this humble brag about. I was buying Pappy when you could walk into a store, literally in Manhattan of all places, and there it is. And I'm talking the 23-year-old up on the shelf at a retail price. So I go
Really?
back to early days of I still have, now the hard part is I know when it's worth opening up a bottle of 23-year-old that I know is worth $5,000 and just having a glass, I don't know. I have this mental challenge right now. I have fortunately a couple of older bottles of 23-year-old and that are just sitting there staring at me. I don't know what I'm waiting for, but I've recently stumbled at Old Fitzgerald. It's a bourbon. And, so my daily hasn't been Pappy, it's been Weller for a long time, which is a wheated bourbon. And so now I've recently stumbled into Old Fitzgerald, which is kind of like my
Yeah.
favorite wheated bourbon right now. It's good stuff.
I've been on a
Highly
little
recommend.
bit of an Eagle Rare kick right now too. So I really enjoy that
Yeah.
one as well.
There's another guest that mentioned Eagle Rare as well, Josh. There's an upcoming conference, I think, in Louisville, so I might have to make our way to a
There we
bourbon.
go. That's it. We should do a little bourbon trip there.
100%. Let's do that. Yeah.
IMS.
thank you both for your time today. I think it was a great discussion, and I hope the listeners really learned something from this. So really appreciate your time.
Thanks,
It's
guys.
great
Thanks for
being
having
here.
me.
Thank you, Jerry.